Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Gene Trowbridge and Jonathan Ney, founding partners of the top syndication firm, Trowbridge Law Group, LLP, have a legal team with over 50 years of combined experience in real estate syndication and the practice of real estate securities law. Over this time, Gene and his partners in several past firms and currently have helped clients raise close to $5 billion in offerings by empowering entrepreneurs to raise capital legally. To learn more about Trowbridge Law Group, LLP, visit their website at trowbridgelawgroup.com or follow them on Facebook, Instagram, or Twitter. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Harper Jones. Thanks for being on the show, Harper.
Hey, yeah, thanks for having me. Excited to talk.
Harper is located in Knoxville, Tennessee, where he invests in real estate and where he focuses on wholesaling and multifamily investments. He prefers to get creative with real estate deals when possible and utilizes infinite banking alongside his investments. So, Harper, welcome again to the show. Grateful to have you on and just to share your time and expertise with us. I've had numerous people recently come on the show and talk about this infinite banking strategy or concept, but I haven't met too many people who are actually investors that are using it. And so Harper, just really put that out there that he's using this, his team's using this strategy. And he also has a very creative deal that he's going to share some tips and stuff with us, how they landed a deal and closed it and was very creative about the financing. And so I think that's very useful for each of us, especially getting into this business and thinking outside the box is difficult in the beginning. But using this new strategy too, I want to hear how his team uses this so we can all potentially benefit from this and learn from him. But Harper, welcome again to the show. Grateful for your time. Give the listeners a little more about just what you're doing in real estate right now, and let's jump in.
Yeah, of course. So, I've been in real estate maybe a little over 4 years. Started off doing some wholesaling, flipping contracts, kind of almost bird dogging properties. Then did a handful of flips or rehabs, flipped that to retail. And at first, we come across some pretty good deals that were, would be great rentals or assets to hold. But I had the scarcity mindset of, I don't want to fix the toilet. I don't want to get the late night calls, but I understand, processes and systems. And not that I have everything set up to a T, but, I've been much more open-minded since then. And we have transitioned to, buying, our first 7 units, then a 6 unit, then a 35 unit, then a 20 unit, and, another 20 unit, and then that, creative finance deal. And there's been a lot of stuff along the way. I guess so to say, I started opening up my mind and more opportunities I started noticing. And that's kind of when we went down the route of trying to think bigger and going from there.
Nice. Well, I appreciate you sharing that. And even just saying like you had a mindset of scarcity, scarcity mindset. And can you elaborate on that just a little bit and what that looked like, but how that you also kind of grew past that?
Yeah, of course. So a lot of it, I would say, comes back to when I'm looking at something, you kind of grow up and you're taught more of a traditional mindset, not only like in life and finance. So like I was taught, hey, let's go to college, and there could be pros and cons about going to college. Is like get a degree, it looks good, and try to go that route. So it's already kind of contrarian to already hop out and try to do your own thing, even though it's the right thing to do, is to at least see, what's out there or do some stuff on the side to try to understand what's going on. And even when I started getting into real estate, when I was saying, hey, I was like not looking at, the rental aspect, holding the assets and the tax benefits, cash flow, equity pay down, appreciation, stuff like that. I just kind of, threw to the side because I was thinking about more the short term instead of the long term. I was like, well, I want that check. And everyone does, like having check and people are impatient and want something now. But for example, I'll give a scenario. So maybe it was 2-ish years ago, maybe 2.5, we were, primarily just doing that wholesaling at that time. But we had, started to build a relationship with this one property owner, and he owned a 5-unit and 4-unit side by side. Decent part of town, not the best part of town. So let's say, C plus or C or something like that. But it's also gotten better since then, that part of town. But it's a decent part of town. And, we've been talking with them back and forth. Property needed a little bit of CapEx, some maintenance. But it was basically fully occupied. Rents were like $3,000. They could be about $4,000 a month. Now they could be about $4,500-ish, probably approximately a month. And we had a contract for $90,000, 10K a unit. So, I mean, that's got to be, I don't know, like a 20 cap. I don't know. So I don't know. I'd have to put it in a spreadsheet or something, 25. I don't know. It was crazy. But I had too much of a scarcity mindset to hold on to it. So we ended up wholesaling that for like 145 or something like that. So we ended up making, I don't know, 50K or something. And I had a partner on that. So we split that. But seeing that check, doing that, I was like, okay, this is awesome. And, we did more of those, of course, but when they came up, but then I turn around, I look at the tax record 2 years later, and the guy turned around and sold it for 300. So he got all the cash flow for 2 years. He bought it for that amount, sold it for 300. I'm glad he did well. And whenever we have wholesale stuff, we want the buyers to do well. We want to build that relationship with them. But I'm like, man, imagine if we'd bought it, we'd put in 30, 40, 50K, had all the cash flow, either refinanced tax-free or sold it. I mean, that's just one scenario of, I think, where the scarcity mindset.
But you learned a great lesson there.
Oh yeah. I mean, it still turned out well. I mean, don't get me wrong. No one went broke taking profits, but anyone could have seen that. And if I had more of a mentors by my side and looking at it with them, they probably would have advised me and pushed stronger to hold that. Sure.
So you didn't have a mentor at that time.
I would say that I had mentors, but I in my head, I was like, let's just wholesale this. Let's make a chunk on this, and
right
on the next one. So it's almost like I wasn't even open to try to bring up the scenario to some of the people that I would consider mentors at that time. I was just kind of laser focused on like, I don't want to hold this. I don't want to deal with tenants, when I could have just outsourced the management, especially with that spread that was there.
Was seeing what this other gentleman did with this, is that what helped you to kind of get past that mindset?
No, because I didn't even look at the tax record still like this spring. When I just pulled it back up and I go, oh yeah, you ended up, I would look at properties we've sold to other people or properties we've owned and then, sold off. And I just like to see what people have done with them, and so I'll drive by, look at the tax record sometime, and I just had noticed that. So I would say there was a 7-unit that came up that was pretty good numbers relatively, and we were kind of fed up with just getting checks and then going back to work for the transactions. We're like, we got to get a little bit of cash flow, and that's when we started. About maybe another, year and a half from that point, or a year from that point, we started buying rentals and holding them.
Okay. Cool. Well, I just think it's such a big deal too. A mindset alone, I just focus on that a lot because it is so important. And just personally, I've just seen that how just having your mindset in the right place, or not having the scarcity mindset. It's hard to get out of that though when you're brought up that way, you're trained that way to think that way your entire life. And like you said, go to college, and not that college is a bad thing, but it's not for everybody, and it's not a must either. To make it. And so I appreciate you bringing that up, but let's jump into this other creative deal a little bit. But ultimately I want you to highlight, how you and your team are using this infinite banking concept personally as an investor, and why that's beneficial. And let's jump into some of the details of that.
Yeah, of course. So I've had, of course, in real estate, you can have, numerous partners, whether it's a, syndication, joint venture, you're flipping houses, wholesaling, partnership, whatever. So over the past few years, I've had 2 main partners, Peter and Hunter, and this is where this creative deal had kind of come through. I kind of headed up, I guess, working on that because I built the relationship with the seller, but ultimately, I'm a big long-term relationship guy, and I was going to buy this with just, maybe a partner or something on the creative finance deal and cash out my partners. So they're like, hey, that's fine. You can have the deal. It's, you can go from there with it. And then with insurance, it's agency Create Tailwind. There's a handful of agents. One's Jim, one's Nick. And I'm like, hey, I want to keep building a long-term relationship with you guys. You guys just want to go in on thirds on this creative finance deal. So we did that. And that's kind of how, that's what I do with, I would say at this point, more like majority of my time, and then I'll hold rentals and invest. But I'm doing this infinite banking and coaching people on how to do it. But we'll circle back around to that and how we set that up after we kind of get the foundation of this specific creative finance deal. So, and just stop me if something I'm being a little confusing or I'm bouncing around, just put me back in line here. So essentially on this seller finance deal, we were still doing some wholesaling stuff, but we had, sent some marketing out. Guy had called in, and, I started building a relationship with him. So over the next, month or two, we had been talking, and basically like the first phone call, he had this commercial building, and he had mentioned a price and said, I don't know, I'd sell it for maybe like $250K or whatever it was. So it's a commercial building close to downtown here in Knoxville and had a billboard. So I was like, okay, like this thing may be worth three and a quarter, I don't know, something like that, 350 to the right buyer, or, what we could get per trip on that rent or whatnot. So I haven't done as much commercial, but I'm looking at it. I'm like, okay, I think that's a reasonable deal. It seems like he may have, a personal thing or two going on where he wants to, cash out. And, he's a little bit older, maybe in his 70s, late 60s. And so I go, okay, well, after talking with him, looking at it, I'm like, what's your timeline on selling? He goes, well, I don't want to sell it. I'm like, well, we just talked for, 30, 45 minutes on the phone. You don't want to, sell that. So I kept, kind of seeing, instead of me saying, hey, price, I'm like, okay, let's get to the root of this and see, what's going on. How can I help this guy out and try to offer him a solution instead of thinking about, the dollar signs, right? So then he says, well, I want to sell that, but only if you buy everything I have. It's all or nothing. So I'm like, okay, well, what else do you have? And it ended up that he had a 8-unit, he had a 10-unit, he had 5 single-family houses. He had 4 modulars he'd built in the 90s, like on permanent foundation on one parcel. So those are actually pretty nice. A triplex in the 90s that he had built. And then there was 2 commercial buildings, a billboard, and then another commercial space with the apartment around back. I think that's all. I probably should have reviewed all the details before I started, chatting about it. But I also did a podcast with our podcast. We have Breakaway Wealth with Create Tailwind, which I can put in the show notes or send to you, which I talk about it. And then there's also a video on our YouTube channel where I actually go through the spreadsheet. So there's more details and stuff. And at that point, it's more fresh on my mind with all the intricate.
Sure.
So I can,
no problem.
shoot that to you to put in there if someone wants to look. But basically, I think at first he wanted like, I don't know, 1.7 million. At first he wanted like 2 million or something like that. But we kept going back and forth. And I'm like, look, your price is just, not working. Like, I think you're just at market or slightly above it. And with all the work, some deferred maintenance, putting all this together, getting the capital, like this is just, I was saying, I don't think these numbers work. But I kept talking with him. I said, so what is it that you really want? He's like, well, we're getting approximately X amount in rent and X amount in cash flow. I'm like, well, what if I were to just give you $6,000 or $6,500 a month, and I'll just pay that until, whatever the balance, is paid off. And he was open-minded to that, with maybe putting like hardly anything down, which would have worked out well, I think, for both parties, except for the fact that when his attorney reviewed it, he says, well, this guy needs a little bit more skin in the game. So I said, okay, wise attorney. So then we went back to the drawing board, and it ended up, I think we had done a few negotiations to change some things around after due diligence and whatnot. But it started off being 50% they would finance at favorable terms. and 50% they wanted, as a down payment. And the number that we ended up settling on was 1.7, right? After we're kind of going through the process, we renegotiate on some things. And I think what ended up happening is we got them to have 800 down. They would finance 900, right? And then there was a house with title issue. So we throw that out. So now I think there's just 4 houses. So that means $850K seller finance loan, $800K down for a total of $1.65 million. Once again, it's maybe a little choppy if I, mess up some things here. But basically, we had set it up to where we need to hold about 115% of the loan balance as collateral, which would be the Exhibit A that, both I and the sellers had agreed on. So we kind of carve out what was, reasonable value for certain properties. Didn't need appraisal or anything. We just agreed on that, right? And those add up. If there's enough room between the Exhibit A value and the number of 850K times 1.15 or, 115% of that number, then I could partially release one of the houses. I would have the right to do that. So essentially you have the seller finance note sitting on a pool of the properties, but I could carve out or partially release certain assets when that's paid down. So they're still protected from their perspective, right? So they're good to go just like a bank. But then I'm over here saying, okay, now I can tap into this equity by partially releasing and now own this house free and clear, get a line of credit against it, sell it off, just hold it free and clear. You have those options there, right? Keep it, clean and simple. But as we're getting to the point of closing this puppy, since we need the 115%, that 850, well, I started looking more due diligence and whatnot. I said, look, we need 100K credit off the 800 down. They wouldn't do it. Remember, they're so stuck on price. They wanted their terms, right? So then you had the 800K, and then I'm like, okay, just knock out 50 or 25. Still wouldn't do it. So I said, okay, then hold a second for 100K, and we'll give you 20K at the end of every 12 months for 5 years. So now they're holding a second, right? Now they got the also the 850. So now they're financing us 950K, right? We get to closing though, and since we only need 115% of 850, and the 100 is a total unsecured over here in the corner, right? We get those proceeds for down. Then we had the assignment fee for my first 2 partners, Peter and Hunter, right, to pay our entity because that's where the deal came from. And adding all that up, well, we assigned off our commercial building that we had the Exhibit A value of the 350 I was kind of mentioning earlier. Well, we assigned that off for 265, right? So those 265 proceeds come to closing against the down payment, right? But simultaneously, we take a paper loss of 85K because that's our allocated purchase price was a 350. We sign off 265. Our entity right there now has a paper loss immediately of 85K, legally and otherwise. That's just how it's played out, how it was structured. We signed off the 8 unit that was further away. It was a nice 8 unit, but we needed some more capital. We didn't want to fork up another 300K, coming down how it was set up. So we signed that off, say for 310, 311 after broker fee that they had in there or whatnot. That's another 300 for the down. So now we have 565. Then there was like a dilapidated commercial building with some land, and we sold that off for say 30. Exhibit A value was say 35. So we got 5K paper loss, whatever. So we're like adding up our paper losses and trying to be smart about it. We'll pay these taxes eventually, right? Because, now we have our basis lower, but that's when we would sell these down the road. So I'd rather take the tax benefits now and then, figure that out later and look at it, down the road. But anyways, we get that closed. We put in about 275K. So some reserve capital, and then whatever additional down payment or closing cost or fees or whatever we had to come with. That's what we injected, me and Nick and Jim, right? And we just split that in thirds. But the terms of the note ended up working out to be on the 850K note. It was increments of $4,000 that we paid them, 0% interest, non-recourse, non-callable. And then, of course, you got the flexibilities with the partial release. As it's paid down, then
I'm not sure how that attorney went along with all that.
well, I mean, it worked out well for them. I mean, they're still protected and they're in a good position. But remember, price. So essentially, we are paying interest because we wouldn't pay that same price. So
Right.
say going to 1.65 million. Well, maybe we would have only paid 1.4 or 1.45, right, or something. So in that scenario, we are paying interest, but on like technically it's not marked out, right? Because we're
Right.
paying more than we would have otherwise paid. So it worked out for everyone in that case. Plus, we bought everything. So. But yeah, I mean, sometimes I think back and I kind of, scratch my head a little bit at times, but I guess we had a good attorney too. So they were going back and forth.
You know that to make it in this business, you must attract passive investors. How do you do that? Learn the secrets at the Virtual Raising Money Summit. Text Whitney to 55444 to get a special pricing of only $97. And I would encourage the listeners to get to watch Harper's video on how he's breaking down all the numbers of this deal, just because it's very creative and there's numerous things that are coming into this deal, how they negotiated and did different things. But I like initially how you didn't just push him, like you mentioned, push him to the price or and push him away right away because he didn't have a price and he acted like he wasn't ready to sell. You were patient and navigated that really well, and ultimately got a lot bigger deal out of it, no doubt about it, and got very creative. So congratulations on that, for sure. I just think we all need to keep that mindset open to, even if they act like they're not ready to sell right now, there may, like you pushed in to see, okay, what's his problem? How can I help him? And by doing that, you opened up a bigger opportunity there. And let's, before we run out of time though, let's get into, the infinite banking concept and how you and your team use that and how that's been beneficial to you.
Yeah. So, we got to have those $275K that we got to use as proceeds coming into the deal up front. So what we do is we'll have our cash value within our whole life policies. We'll take our policy loan, which you got to separate. A life insurance contract or policy is a product or a platform. IBC or infinite banking concept or any of these other terms that people may use, it's all the same thing. I like to use IBC because that's where Nelson Nash had come up with a term and discovered it. I like to give credit there. Is we put those two together. You kind of have two sides of a ledger, right? Your left and right. You got your policy there, and then you got your behavior, right? So we're talking about our behavior right now, and there's a lot of benefits with that. But sometimes I think people kind of, throw them together and they're not the same thing. So, I'll dive into that later. I don't know if we'll have time on this, podcast right now, but anyways, we'll pay our premiums. We have our cash value compounding in there tax-free. When we need it, we'll take a policy loan from the insurance company. We'll put our proceeds into the real estate deal, right? We'll set up a payback schedule to pay us back to ourselves personally and then draft it back into our policy and let it sit there and then redeploy it, right? But that's how, you fund the deal. Then you get to the deal as a whole and you say, okay, we need buy-sell agreements if something were to happen, right? So now the entity has either convertible term policies or whole life policies on all the partners, right? To indemnify in case of a loss or to cash out the partner in case they're, they pass away. Now you can cash out their equity portion and some, so that you're not going to be partners with the person's wife or spouse or whatever it is. Keep it clean, keep it simple. And you can outline that in the operating agreement, how it's set up. So then we set up, the buy sells. Now what we'll do here after we finish up a few more remodels, right? And we sold another house to get some more cash in the account. We're going to convert our terms to whole lives. And that's where we're going to place our reserve capital. That's where we're going to place probably our tax bill, our insurance bill, because we're going to get those passed through every month, but we pay a lump sum every year. So we'll have that cash sit in there, right? Same thing with that $20K that we pay at the end of 12 months to the seller, which is also non-recourse and 0% interest. We're going to have that $1,600, and change or whatever a month coming to us. And instead of us just pocketing that or just letting it sit in an account that's doing nothing, we'll use that to pay our premiums and let it sit in our cash value. And then we'll take a policy loan to now pay them, and then we'll pay ourselves back over time. And by doing that, you get a leverage two assets. You get both the real estate and you get the contract. And that contract itself, the insurance contract set up properly and then practicing IBC correctly, is going to be a beautiful asset that's going to help better your returns through real estate.
Interesting. Tell me, how difficult are the transactions with the insurance company? You put the money in, but then all of a sudden you need to take a loan out so you can go buy this piece of real estate or put, earnest money down, whatever you may use it for. How difficult are those transactions and how quick can those happen?
Yeah. So there's a few factors you got to, put in consideration. A lot of people end up looking at this and they look at the projection or an illustration, and look, illustrations are just one part of the puzzle, one piece of the puzzle. You got to look at, okay, what company is it and what is their home office and what is their protocol and process for taking a policy loan? Because some people could be weeks and weeks. Some people could be 2 or 3 days. Some people are much easier to call in and take a loan versus, send a form and put it in. So you got to look at those factors. So like, for example, you want a mutual insurance company. You want to have someone who's an IBC friendly company who's okay with you taking a lot of policy loans or even advocates for it and has a good product to where, it's not affecting the policy when you're banking with it. But say, for example, I like to say 3 to 5 business days, but if you really need it, you could probably get it in 48 hours, 72 hours by a wire or quicker. But I always like to, give the margin of error.
So it's something we need to be asking about up front when we're looking to utilize this strategy.
Oh yeah, definitely. And I think it really comes down to is you get a good coach, which, would be the agent that you'd work with. And then that's when, they'll coach you on, hey, how to set it up for you or your family or multiple policies or whatever you're doing, which, we're practicing that ourselves at Create Tailwind. And that's what I'm doing is insurance and real estate, but I'm trying to, scale more in real estate so that I can be more hands off on some of the stuff. And then insurance kind of comes back where I'm setting up these types of policies for people. And that's kind of my relationship hub. So I look for quality over quantity. And as quality people come along and I'm building those relationships and they want to learn more about this concept, then, I'll set up those policies for them. And then normally that leads to a lot of good things, through those relationships, like other business opportunities.
What's the downside of this? As an investor, you're putting money into this insurance policy, which is it's gaining interest there, right? And then you can take a loan out and use it for different things. But what's the downside or the con, on the investor side to using something like this?
Yeah, I would say the biggest downside is it's the short term. If you take a guy side by side, one who is incorporating this infinite banking concept with real estate, and one that is just doing real estate without incorporating infinite banking concept. And the earlier years, the guy who's just doing straight real estate will be ahead. But if you're looking long term, you're setting up another asset here, and you'll win midterm and long term. But when you're setting up a policy, there's something that we use the term as cash drag. So every dollar you put into your banking system or your policy or whatever you want to call it, that cash value is not going to be equal to what you pay in the first few years. And it's got to have that cash drag and catch up. It's kind of the same thing as if you start a business, do you expect 100% return in the first year? Well, no, same concept. And you got to be willing to sacrifice in those first few earlier years as you're kind of building up your system. But once it's set, it's set and you really get a rock and roll. And there's a lot of benefits.
When does it pay you?
Well, like, what do you mean by pay you?
Just what's the big pay to doing this? Like, what's the biggest, couple benefits by, utilizing this strategy?
Yeah, sure. And I'm not even mentioning, the death benefit and all that, but, depending on the state, it's heavily creditor protected, right? Your money that's sitting in there. And if your money currently is sitting in someone else's bank while you're waiting to deploy it, just set it in your own bank, which would be the cash value. Once your dollars are in there, they're after-tax dollars. They'll compound at certain guarantees, right? Say 4%, for certain insurance companies. And, companies will pay dividends. They're not guaranteed, but they've paid them over the past 100 years, the companies we work with. And so it could be, upwards of 5 or 6% that it could end up, compounding with as you reinvest the dividend. But all the growth in there is uninterrupted compounding, tax-free. And then if you borrow against it, it's simple interest from the insurance company. So you get to leverage a tax-free compounding pool of money and borrow against it simple interest, who wouldn't want that? That's where you get to leverage the difference between the two, right? And then it's just so easy to flow it back and forth. So like, for example, if your real estate has a mortgage on, you're building equity, but if you tap back into the equity, there's additional fees, credit check, it could be simple interest, but they may just refinance into more of a mortgage, and you're resetting the volume of interest, right? And you don't get the velocity of money in a lot of those cases, especially with the mortgage. But you get to control your own kind of line of credit with the insurance company against your cash value when they're placed in lien on there. So as you make payments back to pay off that policy loan, then you're reopening your line of credit and you can redeploy those funds again, right? So you have a lot of that flexibility, liquidity, and control.
Nice. Okay. Well, it's definitely something I know I and probably the listeners as well have been learning about, because different people have been on just recently talking about how to use the strategy. So I thought it was interesting to hear, your side of it, because you're an investor as well and in the real estate business in a big way and using the strategy. So, but unfortunately, we're going to jump to a few final questions because we're about out of time quickly. But what's a way you've recently improved your business that we could apply to ours?
Yeah, give me just a second to reflect. I guess there's always stuff, but I've always self-managed. My brother's done a lot of the self-managing for a lot of the rentals, but this creative finance deal, I've been self-managing everything. And so kind of seeing the intricate details of the self-managing and doing it over the years with various properties, I think for me personally, and this could be, personal preference, I don't have the scale at this point, since we've sold a lot of our rentals in the past, 6-8 months, that I'm going to outsource to third party. And I think that's going to, greatly benefit, me freeing up more of my time, so that now I can acquire, more assets and spend more time working on myself and, my mindset. That'd be a big thing that I'm currently working on.
What's the number one thing that's contributed to your success?
Being open-minded and building really strong, relationships with people, and just trying to add value to them and not, expect anything in return. Just try to find the people in different industries you want to be around, and just, see how you can add value to them and just consistently build a relationship. And I've seen, a lot of fruits come from that.
And how do you like to give back?
So I like to, let's see here. I would say the best way that I like to give back, at least in the, business world, would be, say I have people that, are reaching out, want to learn about real estate or whatnot. Then, I'll go, walk the properties with them, try to give them, different details of what's going on. And then I'll send them different resources to, have them learn and kind of dive deeper. But I found that in this aspect, right, then you could also say, give back if you donate to different things, but I'm just going to focus on this. But say I'm talking to someone who's reached out to me. I've learned that someone's got to really want to, help themselves and better themselves. So you can't just, toss a man a fish, because then he's always going to come back for fish. You got to teach a man to fish, right? So I'll say, hey, reach out next week or read this book, then reach back out. And the people that keep going through that process and they actually are doing what I'm suggesting, then I can tell that, hey, they're kind of in the right mindset. And then I'm always cool to help those people more and more because they're doing that. But the people that I say, read this book, they don't read the book and they keep reaching out with just random questions. I'm like, I can't help you until you help yourself. Hopefully that makes sense there.
Harper, I'm grateful for your time, grateful for just how you've shared this couple strategies and just creative financing that you've used. I think it helps us just to break out of that scarcity mindset as well, like you described, and think outside the box a little bit. And then also just going through this infinite banking concept, a little more with us. I feel like it's kind of a new strategy. I feel like that's kind of coming out of the woodworks more and more. I know it's been used for a long time, but I don't feel like it's been publicized much, or at least in our industry till recently, anyway, and especially on the show. So grateful for just you explaining that. But tell the listeners how they can get in touch with you and learn more about you.
Yeah, sure. I think the best way to get a hold of me would be emailing me, and you could email me at Harper, jones@gmail.com is probably the best way, and then we can go from there.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.